Good morning, everybody. Welcome to the Flow Show, Monday, the 14th of July. And we're going to have a bit of a busy week, I think, this week, if only on the geopolitical side of things at the least. We've got a couple of central banks coming up. We'll get ready for that today. Morning, Kay. Good weekend?
Morning, Ryan. Yeah, sunny, warm. It was a pretty decent weekend. Oh, happy Bastille Day to our friends who are tuning in from France today. I hope you're not going to storm the Bastille today. It's just too hot out there, guys. Stay with us.
Yeah, exactly that. I managed to go down the beach and burn my feet. Everything else was okay, but I burnt my feet. So that's a bit painful this morning, but such is life. And a bit cooler today. So we'll see what that does. Right, let's get cracking. China's Foreign Minister Wang Yi says China-Australia relations have stabilised and have turned around and have achieved positive results over the past 3 years. There's been lots of meetings between China and Australia bigwigs over the last few days. A bit of an offensive by Albanese over there, so that's all looking good. A reason why we'll probably see Aussie dollar still remaining supported if they're getting on with China, though how long that lasts remains to be seen. We did have a bit of data out of China, and once again, I've not got my calendar ready. Oh no, Friday, all over the place. There we go, boom, boom, boom. Bit of trade balance data out of China, and a bigger surplus than expected. Some increased activity in the trade overall. Exports up 5.8%. Imports grew as well, not as much as expected, but turned around the negative May anyway. So things might be getting more back on an even keel after all the trade front running and disruption we saw in the early part of the year. Still might take a bit of time to sort out, but things look slightly over there, as much as you can call it slightly better for now, but we'll wait and see if that continues. That's a few bits and pieces out from the Bank of Japan. As of July the 10th, they had finished offloading all the stocks they bought up following the banking crisis, the Lehman blow up and all that sort of stuff. They stepped in and bought stocks, and they finished unloading all those as of July the 10th last week, according to data out this morning. What that has done, though, firstly, they had a deadline on next March to be out of all those holdings, so they've done it a bit earlier than expected. And one of the things they've achieved from all that is not creating too much market turmoil in the offloading of all that, but it has brought attention now to all their ETF holdings, which is their next thing they've got to try and unwind. And we're not even at bonds really yet, but the ETFs are the next thing they need to get out of. So the market looking at that, and they'll be hoping that they can achieve the same in not creating too much noise in the market for doing that. Sources are saying they're also likely to consider raising their inflation forecasts at their July meeting. Now, this isn't so much anything that's going to be monetary policy related. Normally if a bank hikes its inflation forecast, you'd expect their rate expectations to change as well. They're really doing that on the back of higher prices in food, which is being widely driven by this issue they've got with rice prices due to bad harvests and having to import more and so on and so forth. So it's a bit more of a mechanical change per se, rather than they think overall prices are rising broadly, which would then insinuate that they might be getting closer to a hike. So it's not quite the news, the hawkish news that some might expect. They're going to do that. It'll be for their fiscal year 2025 inflation forecasts at their meeting. Over in the EU, all this funny money, magic money that they found for defence spending and whatnot and everything else. Apparently it's going to come, some of it's going to come from a new tax on big companies, which will go down like a lead balloon. That's according to the FT anyway. And Politico reporting that they're backing down on digital taxes in their next budget. Now, this is news for two reasons. Digital taxes is something that is focus of trade talks between the US and EU. We've also had, if you remember, Canada said they were going to do that. Then Trump called them out, and then they changed it the very next day. So this is something that's going to be in there. But apparently they're not going to be doing that in the next budget, which means they may be getting a negotiation with the US on that side of things as well. Kay, anything you got comment on the BOJ stuff or anything else?
Nah, not really. Yeah, and I agree. It's not really going to change much for the Bank of Japan that revision so far. They've got still kind of bigger fish to fry now, trade and everything. EU, I don't know. I mean, it was a bit of a surprise that Trump slapped 30 instead of the 25 on top of the EU, right? So I think it's just putting more pressure, but EU has already said that there was no way that they are going to meet the 9th of July deadline. And my question is, are they going to meet the 1st of August deadline now? So I'm tempted to say we are maybe with a little more stress, but we're still at the same point as we were on Friday, despite letters being sent.
Yeah. I'll talk about those in a moment. Firstly, let's go back to some of the Canada data that we got on Friday, Canada jobs, which was a bit of a gangbusters number. We got 83,000 employment changes, was expected to come in just under 1K. So a bit of a bonanza for that. All the other numbers looking good as well. Unemployment rate came in at 6.9%, which was much better. Expected to go up to 7.1. Participation rate went up. So that made that number even better because often, all else being equal, participation rate rises, adds more people to the jobs market. So let's can see that in unemployment rate rising. So that was double bubble good. The only minor niggle, was that the bulk of those gains went into the part-time category or revolving doors, we like to call it. But that's a very, very small niggle from that data. So a good one. Can it be maintained? Remains to be seen. But that's going to keep the Bank of Canada probably on hold for a little bit longer. No need to change on the back of those jobs numbers anyway. And that was reflected in the swaps market, Canadian swaps market, which now only see an 18% chance of a cut this month, down from 27% from before that data. Fed Goolsbeast says new tariff threats could delay rate cuts. It says Fed leaders are going to block out political influence. And says the new Trump tariffs have muddied the inflation outlook. Want to wait until they see the anxiety dying down before being comfortable that the US is back on track to a soft landing. It says if we get a few more months of excellent inflation reports, that would persuade me we're still on the golden path. We did get a headline dropping late on Friday that Fed Chair Powell is apparently considering resigning. Now, reading the story itself, it's a bit of a stretch, really. The argument is coming from someone who thinks that some renovations work that's begun on the Fed to the tune of 2.9 billion that was dropped as a story back in April is getting Powell to think about his position. It's a bit of a fluffy, loose, not real substance story. That did catch the market on the hop a little bit when it dropped, but it's really turned into a bit of a nothingness. Right, on to all the trade stuff. And before Trump got his envelopes and stamps out, BMW CEO said there's a chance that the European auto sector will get a netting mechanism in the trade deal with the US. This is talking about some parts, obviously the autos part of the trade deal. And then Trump was speaking about the letter he sent to Canada and the prospect of potential tariff carve-outs. He said, we will see. So he wasn't closed to it. This is something that when he dropped the letter, he said that some parts that were under trade under the USMCA wouldn't be affected. It all sounds like a bit of a bluster. And that was a case when he also sent letters to the EU and Mexico. Now, that did get a small reaction at the time, but there's lots of things at play at the moment with Trump. There's all this Epstein stuff, which I won't go into massively, but it seems like he's trying to shout a bit louder and distract from that saga, that bum fight that's going on at the moment. But largely the market are taking these letters with a pinch of salt, saying, well, we've got an August the 1st deadline. That's all we need to worry about, whatever letters he sends out. And so the market reaction has been a little less on that. Kay, you just mentioned this, the trade stuff. The market pretty much ignoring these threats now. We've got another deadline, and now the market can sort of switch off for another couple of weeks.
Yeah, in the majors at least, we had this like mini gap open. Don't like to talk about those things, but it's already undone. And yeah, as I was saying earlier, I mean, there are things that have reacted, but there's mainly again those things that react perhaps on the back of a little more risk. So gold is a bit higher, but if you look at the majors, we're just basically doing what we were doing on Friday. As you say, the market is just waiting for what's going to happen. Really, I mean, imagine that we had, or recall what we had as moves when he announced stuff on Mexico the first couple of times. Dollar Mex would rally a couple of percent. Now it just rallied a couple of 100 points, and here we are, basically back to where we left it on Friday. So yeah, the market is really they need, and as I've been saying last week as well, they need real data, real numbers to put in their models, and then see where things come out. And as also we've been saying, they might have to change those numbers a number of times, but maybe they have done it too much in the past, and now they are just waiting for the final one to adjust the models. So yeah, I think there's a lot of short-term stuff going on, and we are waiting again.
Yeah, and I mentioned it last week that this week is probably going to be all about geopolitics after we got over the tariff deadline hump, and that looks to be the case. We've still got this Trump major Russia statement today, which Axios is reporting he's going to announce aggressive Ukraine weapons plan, essentially among other stuff like sanctions and whatnot. So the market is switching into this mode, I think, today. Just seeing a little bit of that in some of the price action. We're seeing the dollar a little bit better bid. We're going into potentially risk off where we see a run to the dollar, which could mean an exit out of the euro, because obviously geographically closer to Ukraine than the US is. So this is what we've got coming this week. And again, this is another week where we're going to be potentially trading something different to what we were last week, and completely different scenarios. So you need to bear that in mind when monitoring the price action, try and work out what's happening. The Kremlin say that they expect proposals from the Ukraine on dates for the continuation of talks, but they don't look like they're in a hurry to get any dates done themselves. And on Trump's major statement, says we are waiting for it and want to understand what he meant on the EU proposed floating price cap on Russian oil. And they said they have good experience with minimising such actions, like selling oil out the back door, as they have been. Also, the EU Foreign Policy Chief Kallas says that they will raise China's enabling of the Russian war in Ukraine at their EU-China summit in a couple of weeks. So this stuff's all getting heated up with Russia. So expect more headlines, more truth bombs, and more rhetoric. And as I say, we're probably going to be trading risk a bit more than anything else this week. What do you see coming from this, Kay? I mean, the market sort of ignores it when there's something else to concentrate on, but we're over the tariff deadline. Central banks are not really a trade at the moment. They're going to be concentrating on this stuff, I think.
Yeah, then a bit of US CPI this week. The thing is, yeah, I'm kind of thinking the geopolitical side may be a bigger thing indeed, because we're expecting already there's already some decent expectations of sticky CPI, etc. in the States. So obviously it's going to be monitored, but yeah, Trump's statement on Russia will probably be a mover, you know. Risk is one thing. I'm not so sure that if he announces like bigger support for Ukraine, like de facto sending more weapons, defense, and stuff, that the euros should be suffering more. But it's all like two-edged sword. It could actually be good for Europe, because that means that US is still in the game, and they are still supporting Ukraine as well. On the other hand, obviously, a step up in involvement is going to be scrutinized by risk traders, and but there I'm especially thinking again about the metals. Again, gold could be the one that outperforms. It's going to depend on to what stage is he going to get involved. We've already been saying, if he sticks to sanctions, it should not have a big impact. I mean, sending more weapons, sending more defense. If it's aggressive weapons, it's probably going to have a bigger impact. But I mean, the one step which would be seen by Russia, and then probably as well China also, the step too far is boots on the ground. But I don't think he's going to go that far, because that would be like a really big step. Yeah.
Yeah, no, I agree. I think it's going to be weapon stuff, and yeah, I don't know. You know what's going to happen if because Germany's talked about buying Patriot stuff off of the US to give to Ukraine. So we've got all this defence spending that Europe wants to do and increased budgets and whatnot. But you know, in normal times it would be good for growth and whatever. But if you're buying or spending stuff on defence and then just giving it all to Ukraine for an IOU, it has the opposite effect, because you're not actually getting any income from it. And we know what Russia's going to do. Any increase in armaments to the Ukraine, they're going to say, well, you know, the West is stepping up their interference, and thus it needs a stronger response from Russia. So expect more threats of how it will lead to World War III and this and that and the other. And, you know, that's when it falls into the risk category more than anything else. So it's another known unknown that we're going to have to deal with this week. Let's look at what else is coming up. It's fairly quiet-ish on the data front. We've got a bit more data out of China coming up early in the morning tomorrow. And then we get some CPI numbers. We get Canada CPI as well as US CPI. So it's going to be double bubble. And the reason this CPI is going to be important, as I've been mentioning for the prior week or so, is not so much for what happens at the July meeting, but whether Powell and the Fed are justified in keeping rates up. Inflation is expected to rise 2 pips to 2.8% year on year. The core is expected to rise 2 pips as well to 3% year on year. And if it comes in around those numbers, then yes, Powell and the Fed are justified in keeping rates up. If that happens, then any lasting expectations for a July cut will be squeezed out. and we'll probably see a reduction in September as well. No doubt we'll get Trump waffling at some point or other. But if inflation comes in softer than expectations, or even lower than last month, then Powell is going to be looked to be wrong on his inflation call, and then Trump's going to nail him for keeping rates on hold. So he's a bit of a damned if he does, damned if he doesn't at this moment. Powell is either proved right, which goes against their mandate, and he sees high inflation, or inflation comes down, which is what the Fed wants, but then he's proved wrong because he was expecting it to go up. Either way, I don't think it matters for the July meeting so much, but it's going to affect potentially what all the other Fed heads vote for, put forward at the next FOMC. So it's going to be a pretty big deal either way on those numbers. We get Empire Manufacturing as well, which kicks off the manufacturing month for July. And then obviously all the PMIs and that are going to follow thereafter. On Wednesday, it's going to be some important UK data, CPI, because that's coming ahead of Thursday's Bank of England meeting. So keep an eye on those numbers as well. Softer CPI there is probably going to increase the case for a Bank of England cut, which some of the market is looking at possibly coming up at their next meeting. We also get the jobs report as well. So that's going to be on Thursday. Sorry, it's not the Bank of England this week, but they get the jobs report on Thursday. It's again going to be big details because jobs is something they're going to be looking at after that wonky one that they got last month, which has raised expectations for cuts as well. Back to the US, Wednesday is PPI, so that'll be a follow-up from the CPI data. And then Thursday we also get Aussie jobs, which is going to be watched for the surprisingly on hold RBA to see if that changes as well. Retail sales from the US, Philly Fed manufacturing, and some housing data coming in on Thursday for the Yanks. And then on Friday, we get CPI data from Japan. And then we get the first Michigan numbers of the month there and some other housing data. Kate, anything out of that lot tickles your fancy?
Yeah, well, as we've already said, CPI. The other one, which may be a kicker, is we know that PPI is more volatile, but we've got industrial production as well on the same day in the US, and those kind of numbers are going to be a bit of a barometer whether his tariff stuff works to produce more in the US and things. So it may be too early for that one to really be a market mover, but it may become the market mover over time. And I just want to say that this is a number that may creep up the ladder of importance in data the further we go.
Yeah, absolutely. Could well do. We shall wait and see. Anyway, so decent bit of data coming up this week to keep our eyes on. Yeah, we don't want to. I don't know what to make of the rest of it really. Manufacturing, we know, is in a bit of a slump. So if we get a bit of an improvement from the Philly Fed and the Empire State, that might give particularly commodities a bit of a lift from that. But otherwise, not too much around. Right, let's have a quick look at your questions. Galaxy, more weapons and sanctions help stop aggression and protects democracy. Yeah, I'm not sure Putin agrees with that, but we shall wait and see. Right. Anything else for anything else, Kay?
No, I think that's already enough to watch this week.
Yeah, well, I can't wait for the weekend. Right, let's have a look at what's going on the price front. So looking at the dollar, as I said, it's looking a bit stronger today. Whether that's a risk move or what, who knows. US yields have been trucking up a little bit as well. They're going to need close watching over the CPI data. And I would think particularly the short end in case there's a big drop in CPI, which then will obviously increase rate cut expectations. So we could see a little bit of a move there. Dollar yen, it's trying to hold now above 147. We had this early move up, got up to near this 64 level, 65 level up here. Then we dipped back under 147. This one's still looking pretty bullish, Kay. It's still more on the no reason to be long yen, but also the dollar, as I said, looking a bit firmer as well.
Yeah, exactly. I think it's it's still suffering the yen under the threat of not getting a deal. It could be a very interesting week, as I updated this morning in our room, because Besant going to Osaka, Akazawa desperately trying to talk to him. Oh, Hassett is there as well, or Hexet. Who is it? Who is it? I always mix up.
Lutnick, I think, is clocking up some miles as well.
Yeah, yeah. Oh, yeah. The Amwell account. Yeah. Oh, yeah. Um, So we may not get something. We know that the yen will move on the back of it. So get nothing, all else equal, and the yen may still weaken over the course of the week. And if you want to steer away from dollars, it's probably better to be in a cross. If you don't want to run into a risk of being whipsawed by US data, inflation data, or the others like retail sales and stuff, crosses in the yen are still relatively big. Yeah, Aussie yen, Euro yen, even with the euro having given back some versus the dollar, but Euro yen is still very big as well. There's a few candidates there. Yeah, it's all going to depend because it is also a break or a trigger for potential Bank of Japan moves, and so the market has understood that very well, and that's what is keeping a lid on the yen right now. And but get the premises or get the structure of a deal a bit which would be a bit of a surprise this week because the U.S. officials are saying no, we don't talk about trade this week. But if we get some sort of a structure, then the yen will obviously strengthen and potentially a couple of percentage points because the market is clearly leaning towards the weaker side right now of the yen.
Yeah, but we'll have to see whether that changes the whole outlook, which I don't know if it will for the yen right now, but you never know. Take one item as it comes. Excuse me. Right, so anyway, we're up here. If we're holding above this 147, 147.15 area, then we've got every chance of having a run up, potentially up to 148 and 148.80, 85 is a bit of a big old time level as well. It will mark sort of the top of a range that we've been sitting in for a couple of months up around here. So if we run into trouble up there, can't get through, it might set us up for a bit of a range play. But if we're busting up there, then something's probably changed and then we're flying through. Euro sterling, I know Kay's already in this one. I'm trying to get in. I keep missing the opportunities. I thought this one might be coming a bit lower in the European morning with all that news, but it already reversed by the time I'd got up. We did have a little bit of a pullback overnight. This looks like it's just had a crack at the 70 level, taken a new high by a pip or two. It's looking like it wants to have a little break up. Last chance to get in, do you think, on the UK data, if it's fairly hot?
If you get UK data that are a bit better, yeah, maybe. But sorry, it may be indeed. It was the problem is if you're a retail trader. I'm on 4 different platforms and I see 4 different lows last night on the euro sterling due to the width of the spread. So I'm going to assume we never really traded below 86.40.
Yeah,
I
30 is the
official one.
official, yeah, on Bloomberg. So that's not retail.
Oh, okay. So it's around there. It is, in my opinion, around 25, 35 now. Of course, you've got the level below, under which I'm hiding my stops around 80, 85, 90, 86, 10. But yeah, I'd say for if you want to give it a go, that may be the level to step in, and then you've got a pretty decent, a little bit of leeway and a pretty decent level to where it should rest and bounce from if we get down there again, low 86s or so. I the problem is if if you don't get good numbers out of the UK, where are you going to get in? So I'm relatively happy to be in. I've already traded as usual, doing some slicing, but I still got a fair bit of mine running because I do think there is this potential, to get back. I'm not calling it 90, but at least to get back somewhere up in the, where is it, mid to high 87s or so. That would be, yeah, maybe even 88. That would be possible.
Yeah, yeah. Well, I've got a big old zone up here. It's a bit messy
Where's
my
that?
chart, but this 87, 87, 20-ish is a big old level, as you can see right in there.
You
So
think?
that's
Mm,
going to be a bit of a decider.
yeah, I think it's this whole thing up to 87.60. Yeah.
Yeah,
Where we have been trading around a lot of times, even back into 2023, there was always some traffic going on around there. Yeah, that's likely going to be an interesting one. Yeah, anywhere 87.20 to 60 is a bit of a zone we need to keep an eye on. But it's bid. It's bid, and we know how sterling trades when the market loses. Especially sterling is one of those emotional, I keep on saying it, but emotional currencies where if the market doesn't like it, sterling is going to have a really could be in for a bit of a rough ride. So yeah, I'm kind of okay to keep mine going for now, and for as long as we hold that 86, 85, 90 ish or so, I think there's a chance we are going to get a bit of a move higher still.
yeah. And Ali, if you're in at 86.33, you got your take profit 87.20. You may want to consider trying to keep a bit on, because if this is really going to be moving, and it goes through that 87.20, then yeah, we could be talking up towards the high 80s, even to the 90s. So this is a trade you might want to try and stay on as long as possible. You can always bring your stop up behind and keep it a distance away and still in the profit in case of any dip backs. But yeah, keep an eye on that one. Dolomex going to look at quickly because Friday it was looking like it was turning the corner. Now we're back down again. It's not, doesn't look like it's ready to bust a big move higher. It did just break this last series of lower lows, but that's again just a short term move coming up to there. But we couldn't get through this 1877 area. This 1857 is looking like it's the key level ahead of the prior lows at 55s and obviously the 50s. So I'm going to be watching that one again. Still feeling like I want to be long, but I don't want to be long here. I want to see if I can get a dip back down to these levels. Then I'll perhaps close off my short and try along. You got any feeling for this one, Kay?
No, I was lucky to close mine. When was it? Thursday night or so. Well, lucky, yes and no, because when I look at it, I'm so not impressed about the bounce. It's still mixed. It's can move like 1%, 2%, 3% if it wants to, but it doesn't. You got like the best is like 0.5% move, and then we stop already, and I'm so not impressed with this bounce. I'm actually already thinking, give me 1880 and I want to be short again. But it doesn't seem to even get there. It's one of those times where you look at a currency, you say like, yeah, I mean, should be going the other way around because it's such a big level, such a big level. But then the longer it hangs just above that level, and we've been talking about it last week, and I said like I've got the impression people are, oh, we are not seeing 1850, so I'm going to buy back at 1858, and then the other guy says, well, okay, I didn't get mine at 1858, so I'm going to buy back at 1860. And there's a lot of time too much time to take profit. You see what I mean? And
Yeah.
that to me is the longer we hang around here, I think the bigger is the chance that we actually break through 1850 and go lower.
Yeah, that's a valid point, and it's all on the price. As much as it's looking like it's getting a bit of a bid down here, particularly that 1857 level. You're
Mm.
right. If you don't get a decent bounce, then it does keep the pressure on this one. But I'm not expecting it to drop like a rock from here to
No,
1850. So I think at least on a first test, the 1850 could hold, and then even if it goes 1850, 77, 75s, that would still be decent pips in the bank if you can grab it,
yeah,
and then see what happens. But you know, this is a big old level, so we could just hang around here for a bit. And again, yeah, if I'm long, I'm not going to be closing my eyes and waiting for 21. I'll be watching the PA in case we go back down, because if we do look like breaking it, that could be another runner, and off we
yeah.
go again. So
Mm.
yeah, but you're right. The longer it goes on, the less inclined I'll be to take a bigger long in it. First test, yeah. Second test, less keen, shall we say? But,
Yeah. But we still have to get it, huh? I mean, you're right. We still have to get it. The 1850 test. It could be that we're doing 49, and then all of a sudden we find ourselves at three quarters again.
yeah,
The thing is though is a lot of as retail traders we're like so sometimes focused on pips, and then the dollar mix goes up like 200-300 pips, and but it's 0.1%. I mean, it's 0.1, 0.2%, and we shouldn't get carried away too much with those moves, especially in the mix. Sometimes it goes with so much less volume as well than in any other currency. So you have to be a bit careful with saying like, oh, dollar mix is rallying because it goes from 1862 to 1867. I mean, that's not a rally in dollar mix, right?
yeah,
That is just somebody who a drive-by with $100 or $200 million or so in a market, one of the clients, and that's basically it. And that's why I'm saying I'm not that impressed. But anyway, okay. I mean, anything can happen from here because if Trump effectively slaps 30% additionals on Mexico, I mean, I don't see too much of a reason why we should go and buy Mexican peso either.
yeah,
That's for sure. Or closing the door in the wall. That would be another reason why we should not be long mix. But yeah, I mean, there's going to have to be a reason, it seems, for it to really start moving up again. Mm.
yeah. Um, Ayaz, you're late. Where's your letter? I've got a letter from your mum saying why you're
Yellow
late.
card.
Yeah, yellow card. We've already covered the power headline. Long story short, it seems like a load of bluster and fluff with no real substance. 300 BP cuts. As far as I know, that's only Power who's been shouting about that. No one's going to come in the Fed and cut 300 basis points. Historically, we had a 100 basis point cut in 2020. Yeah, and you know the reason why we got that cut is the dollar heading for volatility. When is it not heading for volatility? It's been volatile enough recently of late. So that's the 30-second answer to that question, my friend. Kate, I'm going to ping it over to you, mate.
Yeah. Um, what else was there? There was your sterling. Euro. I don't see many other questions. Do I see any other questions about currencies? Let me see. No, yeah, okay, Euro sterling. Pop, pop, pop. Dollar Swiss. Yeah, dollar Swiss. Dollar Swiss is the thing is with the dollar. I'll have a quick look at it, but um, levels where we are now is still bearish. But we are going to need a different pair to move higher if we want dollar Swiss to move up. Gold has had this is bid again. It's bid again because of the risk of tariffs, because of the risk of geopolitics, because of yeah, all those factors. Um, some say gold and Bitcoin are running together, but I beg to differ because they usually one moves not at the same time as the other. I'm refusing to draw a parallel between both right now, although they show similarities. Um, we are here again, 33.73 quarters. That's your gateway to 3400. And as I've been saying, it's been holding even when there was the reason to correct further, which I actually thought there was a good reason to correct further at the time. It's been bit, and it's coming back very, very easily. Um, it's probably going to remain bit until we know what Trump wants to do with at least Russia. We will see tomorrow. If you get a, let's say, the surprise of a not so sticky CPI in the US, I think is going to push through. But even so, before the announcement, I think this is bit, and there is a fair chance we're going back to at least close to 3,400. I don't think we are going to break fresh highs right now. But there is a chance, just looking the fact how it trades, that we are going to push through. The other one, which is really interesting, and I'm quite happy about that, is silver is pushing through. And let's go from long to shorter term first, because I've been given many reasons why this 34.85 is a big level. It's been traded here. It's also the 61.8 of the whole 2011 2020 decline. Um, so we're pushing through now. The 78.6 comes in at around 41 and a half, and it really looks like we are going towards creeping up to, or actually creeping is an understatement, rallying up to that level, because it is extremely big. And then if we go on to the shorter term, we've had this extension here of this corrective move coming in around 38.45. It's been only a very temporary stop in the markets. We are already through. Next level is to me, but that's really a minor level, 39.40s. That could be one. Obviously, we are going to start talking about 40, the figure. Could be a bit psychological. I wouldn't rule out a bit of profit taking as well. Also, if you look at how silver is outperforming gold right now, perhaps there will be a few people wanting to take a bit of profit in gold versus silver. So maybe around 40 and a quarter, we see some resistance there. But this thing is extremely bit still. I'm looking for this zone ultimately to start offloading a big part of my really long-term ones. I've already offloaded the ads today, the rest of the ads that I added back around 36.60 the other day. I've offloaded them this morning around here. Um, but yeah, I'm looking for this 41 and a half. And we are now creating a new zone of support, which is 37.15.30. That's the in between the very big level. Just above there now, we are already starting to create a support zone, 37.15, 37.30. If we would see some kind of a profit-taking wave, that should now show up, and I'm going to get interested if we get back down there to perhaps add on again to my longer term. I think there's a lot of demand as well. It's as we know, it's an industrial metal, and unfortunately, the reasons why are not the very positive ones. I don't think it's pure speculation. I think there's if you want to replenish your arsenal of drones and whatever weapons you're using, the use of silver is pretty clear as well. And unfortunately, I think, amongst others, that is one of the reasons why this is also pushing through, because the supply of it is not always abundant, of what I understand reading various articles. So that for silver. What else are we looking at, guys? Have you looked at the Aussie, Ryan?
No, you can look at it, mate.
Okay, so we're holding again this 35.50 zone. We actually didn't get below, so still positive, but slow, 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 slow. It's a slow mover. We do need to break back above this 65.90 figure to have a chance to move higher. It is a slow mover. And this week, is it tomorrow or the day after where we have our oh no, it's actually later in the week, the employment report in Australia only on Thursday. What else did we have? I thought I saw something Aussie consumer sentiment tomorrow. It's going to be dollars and risk, probably. The effect of copper, etc. Maybe not so much. Yeah, slow mover, but we have our little support zone there. 65, as I said, 90 figure, we need to get above to continue to push higher, okay? Otherwise, very slow. Kiwi even slower. That's even not managing to keep the 60 the figure right now. So it's a real underperformer. People in the room looking at that Aussie Kiwi. Also, we're still in that big range or like channel, but it's more like a range than a channel. We are on a bit of a zone here coming in 109, 70, 80, but we can see here that the Aussie has been a clear outperformer. I don't see too much of a reason to change that right here and now, okay? So if anything, I'd rather, if I want to be long one of the two, I'd still rather be in Aussie than in the Kiwi. Yeah, so I was looking at that Swiss. This I think is just the somebody trying to get some retail traders out of weak stops. Unfortunately, some may have fallen victim again to stealing brokers, but okay, it never really traded below 92, 95 in the market. Euro Swiss, it's holding, but for the dollar Swiss, and now I'm going to reply to Ali's question, for the dollar Swiss to rebound, we are going to need to see some more global Swiss weakness, okay? And to see global Swiss weakness, the biggest or the best barometer is still going to be Euro Swiss. You can trade whatever cross you want against the Swiss. They like to do Swiss yen, they like to do yeah, Aussie Swiss, Canada Swiss, whatever, Sterling Swiss, you name it. But this is your barometer, okay? For if you want to know whether the Swiss is still doing well or not, if Swiss needs to weaken, this is going to go up, okay? And for as long as that doesn't happen or hangs around here, dollar Swiss is going to be a dollar play. And in the meantime, if you look at it, and I even did an update my chart if you wish. Whoops, why is that not doing what I want it to do? It's still bearish, you know. I mean, for as long as we are below 80 40, 80 80, nothing's changed. And this is still globally speaking bearish. All right. The day that Euro Swiss starts to move higher, well, of course, it's going to be dependent on euro dollar as well, but this has a much bigger chance of then starting to rebound, okay? Obviously, if euro dollar collapses, your dollar Swiss is probably going to go higher, but then you might as well do euro dollar because the euro Swiss is probably not going to raise much, okay? So, I mean, to get involved in Swiss, unless you want to be doing what the central banks are doing, and it is to actually incrementally up their holding of Swiss, as we have seen. I don't see actually too much of a reason to trade dollar Swiss unless euro Swiss starts to move. And with that, Mr. Ryan, back over to you, mate.
Thank you very much, mate. Good stuff as always. That's it for today. We've got you set up for the week ahead, hopefully. So you know what's coming, know how to deal with it, and we'll guide you through the rest of the week as we normally do. Have a good one, everybody. We'll see you tomorrow.